Here's something most people in quant finance don't say out loud. The hedge funds that pioneered algorithmic trading, the ones that have been doing this for decades, are not necessarily moving the fastest when it comes to using AI inside their core trading systems. And that might sound strange, because these are the firms with the capital, the talent, the data, and the infrastructure. But in many cases, they are still being extremely cautious. Meanwhile, a retail trader sitting at home with a laptop and an AI tool can now test trading ideas in a way that used to require a team of quants, coding knowledge, and months of development time. That's the shift happening right now. So today, let's break down why this is happening, and more importantly, what it means for anyone who wants to trade more systematically. Now let's start with a quick reframe, because the word quant gets thrown around a lot in a way that makes it sound more complicated than it needs to be. At its core, quant trading simply means this. Instead of making trading decisions based on gut feel, news, or emotion, you build a systematic, rule-based approach. You define the conditions, you test them against historical data, and then you let the system execute without constantly interfering emotionally. That's it. The reason quant trading has been associated with PhDs, hedge funds, and Wall Street institutions is not because the concept is impossible to understand. It's because for most of the past decades, execution was difficult. To do it properly, you needed to write code. You needed clean data. You needed backtesting software. You needed technical infrastructures that regular traders don't usually have access to. And on top of that, you needed enough statistical understanding to tell the difference between a real edge and a random coincidence. So the barrier was never just the idea. The barrier was the infrastructure. And that is exactly what AI has started to dismantle. Now, before we talk about retail traders, we need to be honest about what is happening at the institutional level, because it's more complicated than the headline suggests. If you follow quant finance, you might assume that the biggest firms would be the fastest to adopt AI. After all, they have the money, they have talent, and they have data. And yes, they are using AI, but not always in the way that people imagine. In many firms, AI is being used to streamline internal operations, research summaries, code assistance, workflow automation, internal tools, things that help the business run faster. But when it comes to actual trading algorithms, the core intellectual property of the firm, adoption, is much more cautious. And there are two major reasons for that. The first is hallucination. Even advanced AI models can still produce confident-sounding outputs that are simply wrong. In most industries, that is inconvenient. In live trading, that can be extremely costly. When a firm is executing at massive scale, one back signal can translate into millions of dollars in losses. So the tolerance for AI error is very low. The second reason is even more important: proprietary code. For AI to meaningfully improve a trading strategies, it needs context. It needs to understand the data structure, the strategy logic, and the parameters, the historical test results, the executional rules. So that is basically the firm's intellectual property. That is the crown jewel. And many firms are not comfortable feeding that into external AI systems. So you end up with a strange situation. Some of the most sophisticated financial institutions in the world are using AI aggressively in certain areas, but very carefully when it comes to trading systems that matter most. And this is where things get interesting for retail traders. Because the two biggest constraints institutions face, scale risk and IP risk, do not apply to you in the same way. You are not protecting a billion-dollar proprietary strategy. You are not executing at a size where one AI-assisted mistake can move millions of dollars. You are starting from a much smaller base. And that gives you something institutions do not always have: freedom to experiment. Institutions have more resources, but they always have to be more constraints. Retail traders, on the other hand, have fewer resources, but they often have more flexibility. And right now, the flexibility matters, because for the first time, a regular trader who is willing to learn systematic methods can access tools that would have been almost impossible to use just a few years ago. Let's take backtesting as an example. In the past, backtesting meant writing Python code, pulling data from an API, cleaning the data, building your own testing framework, debugging it for weeks. And most retail traders never even got started because the setup alone was too technical. Today, you can describe a strategy in plain language. You can get AI to help generate the code. You can run it through a backtesting platform, and you can also start reviewing historical results much faster than before. The question is no longer, do I have the tools to test my ideas? The question is now, Do I have a proper process to test them well? And this part is where we need to be careful, because it's very easy to hear all of this and think, great, I'll just ask ChatGPT to build me a trading strategy and I'm done. But that is not the move. AI can help you move faster, but it does not replace trading discipline. The reason systematic traders can build better strategies is not just because they use tools. It is because they follow a process. They start with an idea worth testing, not a random feeling, not a TikTok prediction, not a one-off chart pattern. A real idea based on market behavior, data, or a validated research concept. Then they test it, not just over the last few months, but across different market conditions, different time periods, different regimes, because that is how you separate a possible edge from a coincidence. Then they refine it, not just by over-optimizing the parameters until the backtest looks good, but by understanding why the strategy works. Because if you do not understand why a strategy works, you will not know what to do when the market conditions change. And only after that do they trade it, systematically, with rules, with risk controls, and without constantly overriding the system because of fear or greed. And that is the real process. Ideate, backtest, optimize, and trade. AI helps you move through the process faster, but AI is not a replacement for that process itself. The traders who treat AI as a shortcut will get shortcut results. The traders who use AI to accelerate a discipline framework are the ones building something real. And this changes how we should think about learning quant trading. Because the tools available now have genuinely lowered the barrier to entry, you no longer need to be a professional programmer just to run your first systematic test. You no longer need a finance degree just to understand the basic structure of a backtest, but you do need a framework. You need to know what to test, how to test it, how to read the result, and how to decide whether an idea is actually worth trading. That is what is happening in the retail quant space right now. More people are realizing that systematic trading is no longer only an institutional game. Working professionals, manual traders, people without coding backgrounds, they are all finding their own ideas, backtesting it at the comfort of their own homes. And they are starting to apply systematic methods for the first time. Not because AI made trading easy, but because AI made the entry point accessible. And that is a very important difference. If you want to see what this looks like in practice, how to move from a trading idea to a structured backtesting process, we cover all of that inside our free Quant Accelerator Masterclass. It walks through the framework from the beginning, including the tools, the process, and how to think more systematically as a trader. The link is in the description below. So, is AI replacing quant traders? At the institutional level, not really. If anything, the constraints of scale, risk, and intellectual property means many firms are being careful in ways that slow them down. But at the retail level, the question is different. AI is not replacing retail quant traders because most retail traders are not systematic yet. What AI is doing is making systematic trading more accessible than ever before. And it opens a window where the trader who learns to use AI properly, who understands the process, who tests instead of guess, and who builds with discipline has a real advantage. AI will not replace the trader, but the trader who learns to use AI systematically may replace the ones who doesn't. If this topic interests you, subscribe to our channel. We cover systematic trading, quant strategies, and AI-powered investing every week. And drop a comment below. Are you already trading systematically, or is this completely a new territory for you? I'll see you in the next one.